Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to the first webinar in our dental series. Today's topic is employee retention credit, PPP loan forgiveness, and more. I notice a lot of familiar names on the attendee list. I know a lot of you have been a part of our past webinars. We've done our PPP webinars, and I see my video is off. Sorry about that, everybody. So we've done our past dental webinars, our PPP webinars, and we're excited to start these back up after a little hiatus over the summer. So we'll jump in here in just a sec, but a couple of quick housekeeping items. If you have a question during the webinar, open up the chat box in Zoom and submit your question to all panelists. We are going to try to leave a few minutes at the end for Q&A. Now, many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. We'd also encourage you clients to share our contact details with other contacts in the industry who could use our help. Over the last year and a half, it's been very clear that there are a lot of practices out there that aren't getting the advice or the help that they need. And obviously, we're happy to step in and help. Now, if you're not a client and you have questions, please reach out to me and I'll get you connected to a subject matter expert here at SVA who can get those questions answered. So today we're going to talk a little bit about PPP loan forgiveness. We're going to dive into the employee retention tax credit, and then we're going to go into some other topics as well. And if you've attended any of our past webinars, you're probably already familiar with Matt Vanderloo. But Matt is now SVA's CEO and also a principal in our healthcare practice. And we'll be introducing for the first time Joel Recklich, who's a manager in our healthcare practice as well, and an enrolled agent. Both Matt and Joel help lead the team that work with dentists around Wisconsin and really all around the Midwest to help them minimize taxes and maximize profitability. So with that, I'll be back for the Q&A, but Matt, I'm going to let you take it from here.
Great. Thanks, Lee. Welcome, everybody. So glad you could join us today. So to start this off, we're going to do a real quick touch on the Paycheck Protection Program, those PPP loans. We've done a bunch of webinars here at SVA on these, send out a lot of e-blasts on these. So I think most people are probably pretty familiar with these, but just to make sure, wanted to touch on a couple highlights as they pertain to our presentation today. So remember, the PPP loans are 100% forgivable. So potentially you can have that entire loan forgiven, not have to repay any of it. A maximum of 60% of that loan can be forgiven, or I'm sorry, a minimum of 60% of that loan has to be forgiven based on your payroll costs during your covered period. And a maximum of 40% of that PPP loan can be forgiven on non-payroll costs like rent, utilities, mortgage interest, some operational expenses, some supplies, worker protection expenditures, so lots of different things that fall there. And the forgiveness is based on the qualified expenses you have during your covered period. Then that covered period is either the first 8 weeks or the first 24 weeks after you get the loan. So you've got potentially a really long time to spend those dollars. And then you need to do that forgiveness application by 10 months after the end of your covered period. If you don't want to have to make any payments on the loan, you can actually take a little bit longer to do that forgiveness application. But if you take more than 10 months, you are going to have to start repaying some of that loan while you're in the process of applying for forgiveness. So some really important stuff there on what costs we can use to get the loan forgiven. We had a lot of clients who initially were just thinking about getting 100% of the loan forgiven based on their payroll costs, because most of the practices we work with, almost all the practices we work with, had more than enough in payroll costs in that 24-week covered period to get the entire loan forgiven. But we want to talk a little bit about the employee retention tax credit and how that interplays with the PPP loan and why you might want to think about that forgiveness a little bit differently. So with that, I'm going to hand things off to Joel to start walking us through the employee retention credit and how that applies as well.
Thanks, Matt. Welcome, everybody. The employee retention credit, what is it? Congress enacted the ERC to encourage employers to hire and retain employees during the pandemic. The ERC is a refundable tax credit against certain employee wages and employment taxes. If you had a government shutdown or a decline in receipts in 2021 or 2020 when compared to the same quarter in 2019. Eligible wages depend on the number of full-time employees. Owner and related party wages are not eligible for the credit. Originally, a business that received the PPP loan was not eligible to receive the ERC. In January of 2021, the IRS retroactively allowed employers who received the PPP loan to claim the ERC for qualifying wages that are not treated as payroll costs in obtaining the PPP loan forgiveness. We will determine if you qualify in 20 or 21, but first we will look at our first poll question. So our first poll question is, have you evaluated if you qualify for the employee retention credit? Give you a little time to answer the questions. So it looks like some of you did and some of you didn't. Almost a 50-50 split. Okay, so next we're going to look at the qualifications for the employee retention credit. To qualify in 2020, you needed a 50% decline in receipts compared to any quarter in 2019, or you would need a full or partial government shutdown. The WDA recommendation does not qualify for the shutdown. In 2021, you needed a 20% decline in gross receipts compared to the same quarter in 2019. What are the eligible wages? You needed a full-time equivalent of less than 100 employees to have all your wages count. If you had over 100 employees, you could only include wages paid for not working that would be eligible. And in 2021, the full-time equivalent went from 100 to 500. Next, we will look at the decline in gross receipts. So when you're calculating the gross receipts, like I said, in 2020, you need a 50% decline when compared to the same quarter in 2019. And for 2021, it's 80%. So if you do have a qualifying quarter, you must then determine if the following quarter's gross receipts are less than 80% when compared to the same quarter in 2019. In my first example, you could see that the first quarter had 48% in 2020 when compared to 2019, which qualified them. And then in the second quarter, they were at 83%, which was above the 80% threshold. So in this example, they only have one qualifying quarter, but the employer is entitled to the credit in quarter 1 and 2. Now in the second example here, the receipts were not at 80% in the second quarter. So they would qualify in the first quarter and in the second quarter. And then the employer would be entitled to the credit in the first quarter, second, and third quarter. Now it is time for our next poll. If you qualify for the ERC, have you applied for the credit? Give everyone a couple more seconds to answer. All right, it looks like about 10% of you have applied for the credit, 40% have not, and 50% don't know. So let's go to the next question here on how much of a credit can you get. In 2020, it's capped at $5,000 per year per employee, which is a 50% tax credit on up to $10,000 of wages. In 2021, it is a $7,000 per quarter per employee credit. That's a 70% tax credit on up to $10,000 of wages. So you could feasibly have saved $28,000 per employee per year if you had 80% or less in receipts for the first 3 quarters of 2021 when compared to 2019. So then how does the employee retention credit interact with the PPP? Well, like I said before, you cannot use the same wages for the PPP and the ERC. For the PPP, you must use at least 60% for wages, but you could use up to 40% for employer portions of health insurance, mortgage interest, rent, utilities, workforce training, COVID-related expenses like supplies, equipment, and technology. You're looking at sanitizers, air purification, HVAC systems, they all qualify. And like Matt said earlier, the PPP loan is based on 2.5 months of payroll wages. And your forgiveness period could be up to 24 weeks, which is 5.5 months. So if you do qualify for the ERC, you should have plenty of wages available for the PPP as well as the ERC. Next, we'll talk about optimizing. So number one, we want to determine, do we qualify for the ERC? Before we even apply for the PPP loan forgiveness, we need to know this information. So if you do qualify for the ERC, we want to maximize that 40%, the other expenses relating to rent, mortgage interest, utilities, C-19 supplies, equipment, and then strategically use the wage portion at least 60%, enough to cover the entire PPP loan forgiveness to get full forgiveness of the loan, and then use the maximum amount of wages for the ERC. Now, if you do not qualify and you have the PPP second draw loan or in the first quarter of this year, and you know you don't qualify in the second quarter, go ahead and use the wages all the way up through the second quarter. You know, you don't have to go above the forgiveness amount. Just put it right up to that amount and you can get full forgiveness. This way, you're going to keep eligible wages in the third quarter just in case you qualify. On the next slide, I'll give you an example of what not to do. So in this scenario, the practice received a $100,000 loan in March of 2021. After 16 weeks, there was enough payroll wages to cover the PPP loan. And without thinking, on July 1st, they applied for forgiveness and received complete forgiveness. And then a few weeks later, they're reviewing their second quarter 2021 financials and realized that they actually had a 20% decrease in receipts when compared to the same quarter in 2019. So what went wrong here is that they used all the wages from March, April, May, and June for the PPP loan forgiveness. So in this example, they are unable to use any wages towards the employee retention credit. Next, Matt will give you an example of what you should do.
So in our next example here, same basic fact pattern, but we're just going to make a couple tweaks to how, as a client, we think or practice, you should approach this and think about this. If the practice here has the same $100,000 second draw PPP that it received in March of 2021, but instead of doing that application for forgiveness as soon as they can, as soon as they have enough in wages to get that second PPP loan forgiven, the practice waits and doesn't apply for that PPP forgiveness until it's had a chance to really look at the second quarter financial statements. Because in this case, with the facts we've set up, we want to make sure that practice takes a look, realizes that it's had that decrease in receipts in the second quarter here in 2021, and that it qualifies for the employee retention credit in the second quarter of 2021. In this situation, then we want to walk through that process that Joel had talked through. We want to wait on that PPP forgiveness application, see how long we qualify for the employee retention credit. And remember, from the end of that 24-week covered period for the PPP loan, we have a full 10 months to be able to apply for forgiveness without having to pay back any principal or interest on that loan. So we've got plenty of time that we don't have to feel like we need to rush to get that application done. And then in this case, practice can balance between payroll costs and non-payroll costs on the PPP forgiveness, knowing that at least 60% of that PPP loan has to be forgiven on payroll costs. And it can preserve as much as it can of those payroll costs to try and maximize the employee retention credit and still get the full PPP loan forgiveness. So we really want to take our time with the second PPP loan forgiveness application to make sure we've evaluated whether or not the practice qualifies for that employee retention credit, because if you do, with the right planning, we can get you both. We can maximize, get 100% of the PPP loan forgiven and get as much as possible of that employee retention credit going forward. So really to optimize the two, we really want to make sure that, and really look to make sure we qualify or might qualify in any quarters in either 2020, when we compare the same quarter to 2019, or in 2021 compared to 2019. Or there's another opportunity to qualify if the practice was fully or partially shut down due to a government order. As we look at what we can find in terms of government orders, we're finding that that's probably a pretty difficult path for most practices to get to, since they were still able to be open to see emergency cases during most of 2020. So we really are relying more on the revenue reduction to try and get there for practices. And then if you have that second draw PPP loan, we're looking at all the expenses we can during that covered period to make sure we're getting the maximum PPP loan forgiveness. So not just looking at payroll costs, but also looking at health insurance we're paying for employees, COVID specific expenses, whether that's, additional cleaning products, additional safety gear for the employees, or any equipment you might put in place, air purifiers, things like that. Taking a look at rent, mortgage interest, utilities, and getting 40% of the loan forgiven on those expenses so that we only have to use payroll costs for the other 60% of that PPP loan. And then again, that 60% we're using for payroll. And then when we think about forgiveness of the PPP loan and balancing that with the employee retention credit, what we really want to do is, the first step is we always want to make sure we get 100% of that PPP loan forgiven. The income from that is tax-free income, so you're not going to have to worry about any negative tax impact from those dollars. So we always want to make sure we get 100% of the PPP loan forgiven, but then doing everything we can to maximize the employee retention credit on top of the PPP loan forgiveness, and try and leverage everybody into the best situation we can be for both of those. We've talked a lot as we go through this about maximizing that in 2021. A lot of practices would also qualify back in 2020. What we're finding as we talk to a lot of our clients, a lot of other dental practices out there, is that a lot of people, before we got clarity that you could do both the PPP and the employee retention credit, a lot of practices already had done the application for full PPP forgiveness and had done it based just entirely on wages. Because at that point in time, we were under the belief and understanding that we would never be able to qualify for both. We could either do the PPP or the employee retention credit. We are working with some clients to go back and take a look at if there's any opportunity to squeeze a little bit out in the employee retention credit. We don't have as much in wages typically because those wages were used for the PPP loan forgiveness. But we are taking a look with some folks to see if there might be a little bit in wages that we can squeeze out, or there are a few other payroll related costs that can go into that employee retention credit calculation as well. So I think your bigger opportunities in 2021, but you should definitely look at 2020 and make sure there's nothing you can be doing there. With that, we're going to go to our third poll question here today. Did you receive any HHS provider relief funds? So give everybody a couple minutes to look at this and answer. So here we go. So for everybody on today, 73% of you did receive HHS provider relief funds, which is great. Lots of people then were able to take advantage of that and be a part of that program. As a quick reminder that HHS provider relief funds, the PRF dollars, this was a program at the federal level to reimburse practices for healthcare related expenses to either prevent, prepare for, or respond to COVID-19. The funds could also be used to basically reimburse the practice for any lost revenues that were attributable to COVID-19. Very similar to ERTC PPP, where we take a look at the revenue in the practice by quarter for 2019 and 2020 and look and see if there was any decrease in any of those quarters. With the provider relief funds, there is potentially a reporting requirement with HHS. If you had any one payment or any multiple payments that total more than $10,000, you're going to have to do some reporting back to HHS about how you use those dollars in the practice. If you received the provider relief funds between July 1st last year and December 31st of 2020, You need to use all of those funds by December 31st, 2021. And then the reporting you need to do on that with HHS, your reporting window is going to open January 1st of 2022, and you'll need to complete that by March 31st of 2022. So we had a lot of practices that applied for these dollars and got them sometime in that July to December timeframe last year. But we also had some practices who didn't apply quite in that timeframe, were just a little bit later, and they received their funds sometime between January 1st of this year and June 30th of this year. So anybody who received their PRF dollars in that portal has to use the funds by June 30th of next year, 2022, and has to report on those with HHS then between June 1st of 2022 and September 30th of 2022. And all of the reporting for these funds is done online through a portal with the HHS. And that's all we want to talk about for the reporting side of things in this webinar. We do have another webinar coming up in December, on December 10th. We're going to talk through this in more detail. We wanted to save the details about how to do this and how to work through this closer to when people might actually have to start doing these applications and reporting back to HHS. So if you did get those dollars, I encourage you to sign up for that webinar that's coming up in December. We're going to have all sorts of stuff to help you walk through that process and get that application crossed off your to-do list. There is a new phase 4 here and the American Rescue Plan Rural that are coming out that are a part of these HHS PRF dollars. So this is the newest round here. Phase 4 is $17 billion that's going to go out to providers to replace lost revenue, cover any changes in operating expenses from July of 2020 through March of 2021. And then the American Rescue Plan Rural is another $8.5 billion. And it's going to get allocated out to practices based on the amount of service providers furnished to Medicaid, CHIP programs, Medicare beneficiaries. So both of these are for the healthcare industry at large. So it's not just dental providers, but also medical providers as well. But dentists are able to participate in both of these programs if you meet the requirements to participate. So the general distribution out of phase 4, 75% of the funds in this pool are going to be allocated towards revenue losses during that July 1st to 2020 to March 31st, 2021 timeframe, and COVID-related expenses during that period of time as well. 25% of the funds are going to be issued out as bonus payments based on the amount and types of services that practices are providing to Medicaid, CHIP, Medicare patients. So depending on your practice, your patient mix, you might not qualify to receive any of the allocation of that 25% if you're not seeing any patients that qualify under those categories. But if you are, there will be an opportunity to apply and get into that bucket of funds. The 75% that's being allocated on lost revenues, COVID-related expenses, you're going to have to do some more work to see what your loss was in that period of time and what increase in expenses you had that are allocable to COVID during that period of time. I think off the cuff at a high level, what we're seeing is starting in July of last year, lots of our practices on the revenue side really started to rebound, and we're pretty comparable with 2019. So there might not be a lot in lost revenues that practices have to recoup from this program. So it might be more work on the operational expense side to see what increases you have there that could be covered by the program. The American Rescue Plan for rural providers is out there as well. These dollars are getting allocated to providers who, again, service those Medicaid, CHIP, Medicare patients, but those patients who live in rural communities, and that's where the dollars are going to be allocated under this program. So to give folks an idea on the next slide here, we've got a couple of maps that give you an idea of where those rural counties are here in the state of Wisconsin and surrounding areas. So on the left there, we've got all the state of Wisconsin, a lot of the Midwest, all the counties in that, what I'm going to call purple, are in rural areas and would qualify under this program. On the right there, we've got it zoomed in a little bit more towards the Dane County area, the greater Milwaukee area, to give you an idea of where those rural areas are. So if you've got patients that are in those rural areas, you may qualify for these rural dollars coming out of the PRF program.
All right, Matt and Joel, a lot of information, great stuff. I'm just gonna real quick. So Matt, you talked about is it where the patients are located or is it where your practice is located?
I think we need a little bit more clarity from HHS on that exactly. Everything I've seen right now reads where the patients are. So if it's not as important where the practice is, but if you've got patients coming in from one of those rural areas to see your practice, it looks like you might qualify. But I think we're hoping for some further guidance from HHS that's going to make that absolutely clear.
Okay. So we've had a couple questions come in, but I'm going to throw it open. We do have about 5 minutes available for some quick Q&A. So if you have a question, please put your question in the chat box in Zoom, and we'll see if we can get to it. One of the ones that came in a little bit earlier, guys, is we applied for PPP forgiveness a while ago, but haven't heard back. How long should the process take? What's your guys' experience? How long have you seen that taking?
It's been a relatively quick process. For the last couple of people I've had do that application, somewhere in the 2 to 4 week range, people have been hearing back that their loan is forgiven and that things are good to go. I think if you've been waiting for that long, or if you've just been waiting long enough, you want an update, contact your banker that you did the application for the loan with and the forgiveness with. They are well connected with the SVA and can take a look at where that is in the process, give you an idea of how much longer it might be till you hear or what the exact status is on your application.
It looks like somebody had just had a question about specialty dental providers. I'm guessing they're referring to HHS. So do specialty dental providers, would they qualify as well?
Yeah, any of the specialty providers, orthodontists, children's dental practices, periodontists, they would all qualify potentially for any of these HHS dollars in phase 4 here or in the rural program if they meet the requirements, if they've got that loss in revenue, the increase in expenses, or they're seeing patients from the right areas.
Great. Yeah, it looks like I don't think this is a client, but it looks like an ortho practice. So they would qualify.
Yes.
Great. And then I guess another question, as I'm listening to you guys talk about ERC and how to qualify and the different buckets that it comes from, and this might be a difficult question to answer, but when you look at sort of generally dental practices out there, what percentage would you say should qualify for this? We had sort of a mix of what we saw people on the webinar today, what they've said, whether or not they qualify. But can you give us just sort of an overview of what you've seen out there?
Yeah, I'll take a stab at that, and I'll let Joel jump in if he disagrees too much with what I'm saying. What we've seen is that typically practices experienced a pretty big decrease in their receipts in the second quarter of 2020, when COVID was really going at a high level and practices had closed their doors as to everything except emergency patients to really get a handle on things and make sure they had safe procedures in place. So there was a big decrease in that quarter that would have qualified most practices for the employee retention credit back in 2020, second quarter. And then in the third quarter of 2020, by July of 2020, practices had processes in place, were able to see patients in what they felt was a safe way. So they were opening their doors back up, and receipts responded pretty quickly and rebounded pretty quickly. So I see a lot of practices that qualify in the second and third quarter of 2020. The challenge there being that some practices had done their forgiveness application for the first PPP loan for that same period of time before we knew that you could do both the PPP loan and the employee retention credit. So a lot of practices will qualify. There just might not be many dollars there to claim for the employee retention credit and get that credit. I'm not seeing as many practices that qualify based on that receipts decrease in 2021, but there are practices that are qualifying for it. So if you are one of those that does, it's really important to look at, because now we have the knowledge that we can time things a little bit better between those two applications to maximize both for you.
All right, Joel, did you want to disagree with anything there?
No, I had a client that did qualify in 2021, and it was mainly because they had an associate dentist, and the associate dentist no longer worked there. So, I mean, they saw a decrease in production because they had one less dentist. So you might see scenarios like that. You might see scenarios if you were out sick or on vacation, or something along that line that could feasibly push receipts back. And there's a chance that you could qualify. I mean, 20% is not a ton.
Yeah. All right. Well, Matt and Joel, thank you both so much. We've received a couple of other specific questions, but maybe we can reach out to you individually to get those answered. So as we wrap up here, I just want to let you know that you can visit svaaccountants.com/dental, where the recording of this webinar will be available, as well as checklists and e-guides and articles and a list of all of our upcoming events. Our next dental webinar will be on October 28th, and the topic will be dental staffing stats, trends, and tips. Now, at this webinar, we're going to share a high-level overview of our dental staffing survey, which is currently open for participation. Please see our follow-up email, which you'll be getting shortly, for more information. There will also be a link to participate. You may have also received this information from the WDA yesterday. I know they sent out an email on it. But the deadline to participate is this coming Monday, October 4th. Should take about 15 minutes to fill out. But if you do participate, you'll receive the full results. So we encourage you to participate. We've already got some great practices all around the state doing so, but would love to have you as well. So please take the time to do that. And I just want to remind you all that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions come up. And if you're not currently an SVA client, please reach out to me and I'd be happy to get you the answers to the questions that you have. Thank you again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar on October 28th. Bye-bye.